Hi, I'm John Prudhont, and in this segment, we will be looking at the concept of leverage, which can be a many edged blade to either carve out financial benefits to a firm or potentially lead to disaster and insolvency. So, what is the role of leverage? Leverage is simply utilizing debt, which can be harnessed to fund growth in revenues for a company and, in turn, increase shareholder value, in addition to capital raised through issuing stock and through operations. Borrowing is inherently risky, and fluctuations in leverage use can be seen between private and public companies, with public companies favoring equity financing and private companies preferring long term debt during positive economic periods. Private companies reflect elevated leverage ratios spurred by short term debt compared to public companies. When and how leverage is utilized and company structure of corporate debt in relation to other cash generating sources can be explained through financial theories like the trade off theory, which suggests that companies set a preferred benchmark for debt and adjust their borrowing and equity issuance around the arbitrary target. Another theory is the pecking order theory, which posits that companies do not set debt targets, but instead use the cash generated from operations first, then issuance of leverage, and finally selling company stock. This order is theoretically based on the relative costs of raising funds from each source. Agency theories involving leverage suggest that firm management will support higher leverage to gamble on income producing projects or other investment in conflict with the goals of shareholders to preserve capital invested and to maximize return on investment with the lowest possible risk. So, why would any company take on the risks inherent in increasing firm leverage? Well, the positive impacts of leveraging include increased liquidity and working capital to invest in positive margin investments from using debt to fund revenue producing activities for a business for expedited growth, freeing up working capital generated from income generating efforts to provide a liquidity pad for unforeseen expenses, and use of the tax shield to reduce taxable income and related tax liabilities through writing off interest expenses. Leverage can also be cheaper to obtain than cash from stock issuance due to inherent issues with information asymmetry related to the evaluation of corporations involving equity sales. Negative impacts of leveraging can be found from the perspective of economic risk, which includes the increased potential for loan default and bankruptcy due to changes in and shocks to the economy that might result in depressed demand for firm revenue producing products or services, resulting in reduced income, liquid cash, and insolvency due to an inability to have the liquidity on hand at all times to repay interest and debt. An overleveraged corporation has been shown to reduce the operating performance and productivity of a firm, as well as to spur highly leveraged companies to pursue higher yield and higher risk projects. Another potential unwelcome influence is market risk, which can include increased costs of producing products and services. Some of these elevated fees can include wage inflation, increases in prices of raw goods, supply chain issues, elevated commercial space leasing fees, industry related increases in taxes, etc. Market risk can also include exposure to interest rate risk if market rates are higher when the existing short term debt obligations must be refinanced or new leverage must be obtained to complete or expand revenue generation. The metrics used to determine if a company is adequately leveraged or over-leveraged are based on comparisons between results posted in a company's balance sheet, income statement, and statement of cash flows. These metrics include the financial leverage debt ratio or leverage ratio, which is total debt divided by total assets, with a greater ratio indicating elevated leverage and diminished opportunity for increasing debt. The debt to equity ratio can be computed as long term debt divided by total equity, with a ratio in excess of 1 demonstrating that debt financing is relied on more than financing obtained through stock sales. The interest cover ratio, which is the earnings per period divided by the interest expense, with an elevated ratio indicating a company's capacity to pay the interest on its debt. the asset tangibility fixed assets to total assets ratio, the retained earnings ratio, which is net income after taxes minus dividends paid and reflects the percentage of profit reinvested in the business, and the return on capital employed ratio, which measures the effective use of debt. As you can see, leverage can be a many-edged sword for firm stewardship, with the effective use and management of debt allowing a company to carve out improvements to the company's financial position and providing hedges against fluctuations in the market and economic shocks, while over-leveraging a firm can increase its exposure to risks like insolvency, bankruptcy, and catastrophic failure.